has recently completed its annual sales forecast to December 2015. It expects to sell two products, Micro at €240 and Excel at €300. All stocks are to be reduced by 20% from their opening levels by the end of 2015 and are valued using the FIFO method. So Micro and Excel there, we've got sales are expected to be 11,000 units of Micro and 6,500 units of Excel. Stocks of finished goods on the 1st of 1st 2015 are expected to be Micro 800 units at €130 each and Excel 550 units at €150 each. Both products use the same raw materials and skilled labour but in different quantities per unit as follows. So Micro for material X needs 6 kgs and Excel material X needs 4 kgs. Micro material Y needs 5 kgs and then Excel needs 7 kgs of material Y. Micro needs 7 hours of skilled labour and Excel needs 8 hours of skilled labour. Stocks of raw materials on the 1st of 1st 2015 are expected to be material X 7,000 kgs at €1.80 per kg and material Y 5,000 kgs at €3.60 per kg. The expected prices for raw materials during 2015 are material X €2 per kg and material Y €4 per kg. The skilled labour rate is expected to be €12 per hour. Production overhead costs are expected to be variable €5 per skilled labour hour and fixed €180 or €180,400 per annum. Required: A. Prepare a production budget in units. B. Prepare a raw materials purchase budget in units and in euro. C. Prepare a production cost manufacturing budget. And D. Prepare a budgeted trading account if the budgeted cost of a unit of Micro and Excel is €160 and €184 respectively. E. Part 1. Define what is meant by a cash budget and explain 2 advantages of a cash budget. Part 2. The principal budget factor is sales demand in most organisations. State 2 other factors that could also be considered to be the principal budget factor. Alright, so part A, let's get started. So prepare a production budget in units. So how many units do I have to make? So all stocks are to be reduced by 20% from their opening levels by the end of 2015 and are valued using the FIFO method, which means first in, first out. So I use the units that I've produced first, I sell them first, and then I sell the ones that I have made last later on. Okay, so sales are expected to be 11,000 units of Micro and 6,500 units of Excel. So that's the budgeted sales in units. Now, stocks of finished goods, so that on the 1st of 1st, that's your opening stock, are expected to be Micro 800 units and then Excel 550 units. So, closing stock is going to be 80% of the opening stock. So, all stocks are to be reduced by 20% from their opening levels. So, closing stock is going to be 80% of the opening stock. So, 800 units by 80%, 640 units, and 550 by 80%, 440 units. Less closing stock, less opening stock, which is 800 units and 550 units. So we don't have to make them because we already have those in our warehouse. We already have those finished stocks in our warehouse. So budgeted production in units then, 10,840 units of Micro and 6,390 units of Excel. Part B then, we are asked to prepare a raw materials purchase budget in units and in euros. So how do we do that? So prepare a raw materials purchase budget. So both products use the same raw materials and skilled labour but in different quantities. So we're going to look at that information there. So we've got Micro needs 6 kgs of X and Micro needs 5 kgs of Y, and Excel needs 4 kgs of material X and Excel needs 7 kgs of material Y. Stocks of raw materials at the start of the year expected to be 7,000 kgs material X, 5,000 kgs material Y, and then here are the expected prices. So we're going to use the expected prices during the year because we are going to be purchasing these during the the year. We're going to be purchasing the kgs, and that's the prices that they're at. Okay, so let's do this then. So micro, all right, we know from part A how many units we need to make. We need to make 10,840. So material X, micro, needs 6 kgs. So in total, that is 65,040 euro there. Material Y for micro, it needs 5 kgs. So 10,840 units multiplied by 5 kgs is 54,200 euro. Excel needs 4 kgs material X. So Excel, we need to make 6390 units by 4 kgs. That is 25,560 kgs. And then for Y, it is 6,390 units multiplied by 7 kgs per unit. So material Y, we need 44,730 units of Y to make the Excel. Now, we need to have closing stock, which is 80% of the opening stock levels. So we were told that in the question, all costs are to be reduced by 20% from their opening levels. So 7,000 euro, which is our opening stock, material X, multiplied by 80% is 5,600. And then for material Y, it's 5,000 multiplied by 80%, which is 4,000 euro. And then we take away the opening stock. So we take away the opening stock there because that is already in our warehouse. We do not need to purchase that. So we don't have to have that because we don't need to buy that because we already have it in our warehouse. So the budgeted purchases in kgs, what we need to buy for material X is 89,200 kgs, and what we need to buy for material Y is 97,930 kgs. So that is our raw materials purchase budget in units, but we need to get it in euros as well. Now there's 2 different sets of prices here, but we need to multiply it by the prices for during the year because that is the price that we are going to be able to buy it at. We had these bought then in the last year, so the prices have changed, so we're going to multiply them by 2 and by 4. So altogether, purchases for material X is 178,400 euro and material Y 391,720 euro. So that's part B done. Part C, prepare a production cost manufacturing budget. So that is how much it's going to cost to make those units in total. Okay, so we're going to look for all of the costs that are related to making all of the micro and Excel that we need to make. So we know about the materials, okay, how much it's going to cost to make them, but there's also skilled labour in there as well. We scan down through the rest of the question and we can see that there's also variable and fixed costs there too. So we've got variable overheads and fixed overheads to take into account there as well. So this is what the final product is going to look like. That's your production cost or your manufacturing budget, whatever you want to call it. Okay, it's got all of your raw materials costs, it's got your labour costs, your variable overheads and your fixed overheads. And so you've got your total cost and manufacture there. So how do we find each part of that? So we'll go through it bit by bit. So if we're looking at the materials first, we need to remember that all stocks are to be reduced by 20% from their opening levels by the end of 2015 and are valued using the FIFO method. And then we have the stocks of the raw materials expected to be and the expected prices, blah, blah, blah. So we've seen all of that before. But in this manufacturing budget, what we're going to do is opening stock plus purchases minus closing stock. Okay, so we're going to have our opening stock of raw materials, which we have here. So stocks of raw materials on the 1st, so 7,000 kgs at 180 and then 5,000 kgs at 360. So we're going to add them to the purchase of raw materials that we got in part B. And we are going to take away 80% of the opening levels. So we need to have 5,600 kgs of X and 4,000 kgs of Y. And that is at €2 and €4 there respectively. So total cost raw materials €573 520 euro. It's 573,520 euro, sorry. Then next we're going to look for our labour costs. So we're going to multiply the amount of units that we need to produce that we got in part A by the skilled labour number of hours, the 7 and 8 there for each type of product, and we're going to multiply that by €12 per hour. So 10,840 units by 7 hours by €12 per hour, €910,560. And then Excel, 6390 units by 8 hours by €12 per hour, €613,440. So the total cost of labour, 1524000. Then we're going to do the variable overhead. So the variable overheads, we have €5 per skilled labour hour here. So we're going to multiply that by the number of units that we got in part A that we need to produce by our skilled labour, multiplied by the variable cost per skilled labour hour. So micro, 10,840 units by 7 hours by €5 per variable hour is €379,400. And Excel, we have 6,390 units by 8 hours by €5 per variable hour. That is €255,600. Total 635,000. Add the fixed overheads then, the €180,400. Add that in there, and then the total cost of manufacture is €2,912,920. Part D then asks us to prepare a budgeted trading account if the budgeted cost of a unit of micro and Excel is €160 and €184 respectively. Now this is a lot easier than the 2017 and 2019 production questions because you had to figure out what the budgeted cost of a unit of closing stock of the products were. So here they're actually telling us in the questions, so this is making it a lot easier for us. So what is the sales? So we're told that we are expected to sell 11,000 micro and 6,500 Excel. Okay, the selling price is €240 for micro and 300 for Excel. So altogether that is 4,590,000. We add the opening stock of finished goods, which we are told in the question, 800 units of micro at €130 and then 550 units of Excel at €150. That opening stock then is €186,500. The cost of manufacture comes from part C, that is €2,912,920, and then we minus the closing stock of finished goods, okay, which we were given in the question. But the closing stock, the closing amount of units that we need to make is 80% of our opening. So that's 640 units by €160, which were given here in the question. And €440, which is 80% of the 550 units here, multiplied by €184, which we're told here. And that is €183,360. Again, why are we multiplying these here by 80%? It's because we're told that closing stocks are to be reduced by 20% of the opening stock levels. So the total cost of sales there is €2,916,060. Therefore, the gross profit is €1,673,940. So that is part D complete. Part E then, part 1. Define what is meant by a cash budget and explain 2 advantages of a cash budget. And part 2, the principal budget factor is sales demand in most organisations. State 2 other factors that could also be considered to be the principal budget factor. Okay, so part 1 here, define what is meant by a cash budget and explain 2 advantages of a cash budget. So a definition then. A cash budget is a plan or forecast that summarises the expected inflows and outflows of cash during a period. The budget is prepared by the management accountant or by the financial accountant. Advantages of a cash budget. A cash budget will anticipate periods when the organisation will have cash surpluses and will enable it to arrange short-term investments. A cash budget will anticipate periods when the organisation will have cash deficits and will enable it to make arrangements for a loan or overdraft. A cash budget will help in making sure that there is always enough funds available to meet the day-to-day needs of the business. Part 2. The principal budget factor is sales demand in most organisations. State 2 other factors that could also be considered to be the principal budget factor. So what are the factors that limits the sales? Okay, so what is it that stops the sales? So apart from sales demand, the principal budget factor could also be the availability of materials. So that limits the amount of units that are produced. So the availability of the materials, availability of labour, so the people available to make the products, and the capacity of the plant. So a plant can only make a certain amount. So a factory can only make a certain amount of units for the size of it or the machinery or whatever it might be. And then the availability of money. So what money is there available to be able to produce the units then?